My name's Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We hold events multiple times a week from San Jose to San Francisco. I'd like to highlight two events that are coming up. Wednesday, November 8th, Venture Capital Panel, latest innovations, actually funding for IoT startups. That's going to be at the College of San Mateo. Thursday, November 9th, we have another Venture Capital Panel, funding for fintech startups. That's going to be at the Toddy Digital Marketing in Sunnydale. So check out all the details for those events and all of our events on our website, ideatoipo.com. We were launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 55,000 members among all our meetup groups in the Bay Area. And we've completed over 1,809 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none. Is that it? Yeah. That's okay, I'll take it. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. So to that end, we provide content that is practical, actionable, and relevant, stuff that you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem and it attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley? Who here was born and raised in Silicon Valley? Welcome. So whether you were born and raised in Silicon Valley or whether you just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. So in addition to our content-oriented events throughout the week, we also have a social event on Friday nights every few weeks, and that's the TGIF Mixer at the Hyatt Regency Santa Clara. The next one is going to be November 17th, so check out that event, and that's a free event, and again, that's Friday, November 17th, 8 p.m. to 11 p.m. With regard to value, it is important for us to provide value at every one of our events, not just value for your money, which is important, because we know many entrepreneurs are struggling financially, so we make sure that our events are affordable. If you cannot afford the cover charge for whatever reason, come see me and we'll work something out. More importantly, we want to ensure that we provide value at each and every one of our events for your time, which is your most valuable resource. Is anyone here getting any younger? Besides this young lady? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of other players in Silicon Valley. Tonight, we're grateful to TechCode for hosting us at this beautiful venue. So I'd like to have Keisha come up and say a few words.
Hi everybody, welcome to TechCode Silicon Valley. I'm Keisha, I am the event coordinator here. We do specialize in IT or med tech, smart tech, smart home. So we are an AI accelerator and incubator. So we have every couple of months startups that we bring over to China to meet with investors. So if anyone's interested in any of those things, just see me. I'll be up front all night. We have business cards. Or if you're interested in any other events we have here, just drop your business cards into the bowl up front and we'll get you on our list of all the events we have here. So any other questions, I'll be around, and have a good night. Thank you.
So though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. So to that end, we have a robust YouTube channel, youtube.com/ideatoipo. We have tons of videos, and we've documented and archived many of our events. So check out all the videos on our website, youtube.com/ideatoipo. And we have a great partner in this endeavor, and it's Tim Jeggers of Jeggers Films.
Thank you. So I'm Tim. I'm filming the event tonight. I do a lot of work with Rob. If you want to see any of the other events that he's held, you can check out the YouTube channel like he was talking about. I do that. I do events all over the Bay Area. Been doing it for a while. So if you have any questions relative to anything multimedia, I'd be more happy to talk to you about that later. So I'll give it back to Rob and we'll get started. Thank you.
Okay, without further ado, we'll get started with our program. So here's the schedule for the rest of the evening. Our featured speaker will present with slides, and we'll hold questions from the audience till roughly 10 till 8. At that point, we'll open it up to questions. We're going to set up a mic stand, and we'd like you to walk up to the mic stand, use the mic, and we're going to take as many questions as possible till about 8:30 p.m. At that point, we'll end the formal program. We'll open it up for networking, informal questioning of our speaker. As a courtesy to our host, we'd like to close out the program or close out the event at 9 o'clock and leave the building at 9 o'clock. So without further ado, I'd like to introduce our featured speaker tonight. He's one of the top corporate attorneys in Silicon Valley. He is a partner at K&L Gates, one of the top law firms in Silicon Valley. And he is passionate about helping entrepreneurs succeed. So let's hear it for Stan Lewandowski.
So first, thank you, Rob, and Idea to IPO, and our great hosts, TechCode, and welcome everyone. I'm very pleased to see so many faces eager to learn about how to prepare your startup for financing, and the next 45-50 minutes we'll spend talking about issues that will solve many of the problems that you have, and hopefully after today's discussion all of them will be things of the past. Now, I always say one thing every time I talk, regardless of the venue, whether it's Europe, Asia, South America, I have to put some slides about what the material is that I will be covering. All of that is superb information, but it's still for informational purposes only. So take this as educational material and knowledge, and then when you have specific things that pertain to you and your business, then you will have to seek some proper advice, properly documented when you establish that with your counsel. And of course, whatever I'll be talking about does not interfere with our US federal tax system. I'm not going to provide any advice related to those topics. So my name is Stan Lewandowski, and I'm part of a company called K&L Gates. It's one of the largest law firms on the globe, co-founded by someone you probably heard about, who is Bill Gates Sr. This gentleman co-founded K&L Gates years ago, and now we have 5 continents covered, over 45 locations, and pretty much clientele that needs us in all of those jurisdictions, and we are very happy to provide integrated services regardless of where the clients are. As Rob mentioned, I specialize in working with startups, and startups are not just startups that need the first $100,000. Startups are also companies that need the 5th, 10th, and 55th million. A few years ago, as you probably know, there was a legislative act passed called the Jobs Act, and there is a nice definition of an emerging growth company, and that's a company that has 1 billion in revenue somewhere on the horizon. So this is pretty much a nice range to think about when we talk about startups. I say once you get to 1 million, let's call you a scale-up. As you can see, I primarily work in Palo Alto, which is our Silicon Valley office, but you can also find me in San Francisco, LA, sometimes Warsaw, sometimes in places far, far away from California, and that's where my clients take me. If that's needed, just give me 48-hour notice and I will be there, unless the planes don't go there that fast. So I specialize with things related to startups. Again, that means many times I have to work on structuring corporate structures because there is more than one company involved on day one. Most companies you will see have just one entity, and that's a very easy approach. That's pretty much what I call in Silicon Valley commodity advice. You can get this from anywhere. But when you have a crowd such as the one in front of me, which is you, and I find so many things in common with you, because I wasn't born in Silicon Valley, and I think that's the prevailing theme in this room. We have many international features. As I can look through this nice place, I see many similarities. So again, when you have many companies involved, you have to structure things properly, not just one country. Sometimes it's 5 countries on day one, and some companies grow very fast. Again, that then translates into angel and VC financing work, licensing, strategic relations, and the most fascinating moment for any startup founder, an M&A event, which is pretty much a prize that every startup should be aiming for. Once you get there, your 1, 2, 3, sometimes more years of hard work will be really rewarded. So I decided to put 8 items on today's agenda, and I will talk briefly about each of those items. And then I really encourage you to come, take that mic, ask questions, go home with pretty much any issue that you have right now in front of you answered, so you can be better prepared to start your work tomorrow and do your things your way. So again, the first item, how to plan for building your startup when you are not really at that stage today. How to structure allocation of equity, how to deal with restrictions on founder's stock, because they will be required. I want to show you a few things about how stock option plan can be structured and its impact on your share of the pie without changing the share for the investors. Then how much you should raise, what types of securities are available to you, what are the most important diligence issues that you will face when you start talking to sophisticated investors, and common sense approach to closing your financing on time. So before we go to the first slide, how many in the room are already building their own startups? Awesome. How many are working for other players but are thinking about starting a startup at some point? Perfect. Perfect. And I will tell you that in most cases, when I talk to people, a majority people in the audience are those who are still working for somebody else and thinking about the next step. And that's the best moment in your professional life to come to those events and learn as much as possible. So when you are ready, you start on day one, and you will never make a mistake unless it's a very immaterial mistake. So issue number 1. Let's assume that you are working today for one of the big companies in Silicon Valley, and you are dissatisfied with the team of 45 people who are working on a solution to some problem. You don't like the management, you think that you are much smarter, and you don't like the 40 or 45 hours per week that you are working. You like the better side of the equation. You like the 80 or 100 that's in front of you. One of the first things that I talk to my colleagues who are talking to me before they started companies, they want to know what they should be thinking about while still working for somebody else, while they are mentally already in the transition mode. Within 6, 12, 18 months, they know they will no longer be there. They will be in their own garage or tech code. Probably everybody who is in this room who works for this bigger or smaller company has signed something that's called an invention assignment agreement. And that document provides that pretty much everything that you do during the scope of your employment will belong to the company. And that's primarily the core thing that's making the Silicon Valley so great. We create so much intellectual property. The more engineers we have, whether they are from Europe, Asia, South America, you name the continent, the better we are, because we are all at least sometimes passive innovators, but sometimes we participate, even with our small advice, to the active innovation process taking place. So one of the things that people want to know is how can they safely separate from where they are today to the next stage in their lives without really having the tail that will damage the company. Because as you probably know, if you have some taint on your resume, that will prevent any sophisticated investor from having a very sophisticated discussion with you. So what I told them is this: look at your agreement, and since you are an employee, there will be something attached as an exhibit that will say there is a labor code in California, and there is one section that will give you the key to another place. And that key will say that if you are going to work on something unrelated to the company's business on your free time without using the company's resources, you will be able to claim that this intellectual property is yours. If that happens, it's an awesome moment, because now you know that you are in a clean space. You present to the investors, and very likely at some point you get funded. So as you can see on this slide, in essence, everything belongs to the employer. And then there is magic. We have two things that people struggle with, because they say, hey, I did this on my free time. It was Saturday, multiplied by 104 times. I did 2 years of that work, Saturday, Sunday. I didn't take any vacation. I did this at home. I did not use the company computer. I did not borrow the paper clips that some cases say that's enough to get you to the company's side. And now you are telling me that this intellectual property is still the property of my employer? And I say, in some cases, yes. And this is why. So if what you are working on your free time, using your own equipment, still relates to the company's business, and compare this with your specific scope of duties that you have, the company's business is much, much larger. You are doing just a small piece. You will not be able to claim that this was outside of what you did if you cannot claim that this was outside what the employer in general did. So watch out for that. And if this work that you believe is yours is caught by the second prong, so if somehow you did some work for the employer in the last 2 years, and now you're just extending this type of work, claiming that this is at home because you know better, and your 45-person team is not really as smart as you are, that will not really get you outside the box. So how can you solve for this issue if you really know that you have to leave that place? You know that this 45-person team will not work on that solution and will not have a successful resolution in the next 2 years. How can you break away, right? So we look at the facts, and people come to us, and we have to dissect every single item, every fact on the table, and we start with the small ones. Was it outside of your premises? Was it on your own laptop, etc., etc.? Then we get to a point whether this factually is caught by what the employer's general business was. If it is, then there's a problem. And if we still have 10% doubt that this will work as something that can be claimed 100% yours, in some cases, we'll go to the employer and pretty much negotiate documentation that will give this former now employee a break which we call a clean break. So the former employer will sign documentation that simply is our carte blanche now for the new business. Nobody will question this. Simply we can start, and when the investor asks, and they will always ask about your past, how your IP relates to what you did a year or two ago, you can say, whatever I did, take a look at this, and I'm fine. So that's item number one. And the importance of this is that if you are still at the planning stage, you can fix things. If you've already left the station and you are at the second one, building a startup based on something that you are still, let's call it, inadvertently unaware that this is tainted, it's a problematic situation. What are the implications? I stated many of those already, but every single investor will start with your IP story, because most of the talent in this room is creating something for, name it, Cisco, Google, Intel, Synopsys, whatever company we name. Most of you are creators of some intellectual property. And the greatest value in the new companies that will be formed, again, lies in the intellectual property that will be proprietary to your company. That's why it's so important to have clean IP. Now, if the investors start going one by one through your past and start finding things that connect you too much to your past, the likelihood that you will be funded is getting smaller by the minute. And that's why you don't want that. That's why the planning is so important. Now, there are some cases that you've probably read about or heard about, that once you leave your current employer, the clause in an agreement, in many of those agreements, provides that you will notify your existing employer about your new employer. What does that mean? It means that the HR department from your new company is going to get a letter saying that so-and-so worked for us for 3 years and had access to certain information, which is subject to certain agreements between the company and that person, and there are some survival provisions that will make you basically quiet. So that's one thing when you switch and work for somebody else. When you work for yourself, nobody will send you a letter, because now you are your own boss, you have your own company. But if certain taints are found, you will get cease and desist or some other form of a letter that will advise you to stop what you are doing and simply reconsider your future with this new company that you thought was so superb. Item number 2. So we fit within the time frame that we have, and I don't want to deprive you of the ability to come and ask your questions, so let's keep to the schedule. Now, many of my founders, when we solved the first issue, asked me the following: Stan, I've heard about companies that have some special shares, and we don't know anything about those shares. Can you tell us more about them? And I want you to know that most of the companies in Silicon Valley will have something that's called common stock. That will be the only class of stock authorized in the corporate charter. That's called in Delaware Certificate of Incorporation. And there are no special rights attached to those shares. Pretty much one share, one vote. Nothing special. A 2-page document. However, there are founders who want to have, for example, 2, 10, 20, 100 times more votes per share than their colleagues at the next building. And this is where we start being creative, and the documents no longer are 2 pages long, but 7, 10, 11. So if one of you wants to start a company on day one and have many, many votes per share, that's the best start that you can have. And this is the best moment to have that issue implemented. And there are people in the audience with whom we started this process a few days ago. Some came with some brief history at another let's say, location where they didn't receive what they needed. Now we are working together, we are fixing things, still at the stage where things can be fixed, and we are allocating more votes for each share that those founders have, because there are no other people other than 2 or 3 founders, so this is still a good time. Now, just few examples of those stories from the past. If you go online and go to SEC's website, start downloading, for example, documents that are publicly available for LinkedIn, for Zynga, for Google, for many other companies, Groupon, you will find that there were multiple votes per share that the founders had. And that's why every time there is a financing, everybody knows your share ownership will be diluted. So you start maybe with 80-20, you have 80, then there is a financing of 20%. That means that you are now going down, and at some point you will have a minority stake as a founder. So by having the votes, you keep a high number of votes that gives you pretty much control over the voting share ownership in the company. Some founders say, hey, besides just getting those basic voting rights, I want those shares that I will have. And what I do, I divide common into 2 groups. One I call Class A common, which will have, for example, 100 or 20 votes per share, and Class B, which will be with 1 vote per share, nothing special. I can always have the founders convert into Class B anytime they want on a one-to-one basis, or they can stay there forever, and they get liquidation still based on Class A common stock. So with the approval rights, sometimes they will say, you know what, there are certain provisions I'd like to have reserved for me as the holder of Class A stock, just like we will do this later with the investors who will have Series C or Series A stock. And they, because they have 10, 20, 30% of the company, they have to be protected with some protective provisions. So they say, you cannot do the following things without my yes to that. And we do the same for the founders in this stage. And some founders even insist that they Class A will have the right to elect board members by separate vote. It doesn't happen too often, but I want to have you at least have those items in front of you, so when someone starts talking about any of those, you will at least have an idea what those things mean. So we talked about voting privileges. Let's talk about what the founders should think about when you are first allocating equity. And the main things that you will always have, if 2, 3, 4 founders come, the main issue is not what type of shares they will have, but they try to seek advice on who should get what. And that what mostly relates to percentages. And any reasonable lawyer will tell you that you really have to use common sense and try to allocate that equity within reason based on the contributions people will be making. So if you have 4 people and you have a fintech company, one of them is great coder, another one knows the regulations. Let's just assume this is a person who left a big, now publicly traded company that got listed a year ago and says, I can do things at a startup and have this sophisticated knowledge that's very valuable because that knowledge is expensive. Then you have some colleague who thinks that can get financing from different persons, and then you have, I'd say, a lawyer for whatever reason. Then the lawyer maybe will be happy with 5%, maybe that's how much this person would get. The coder would get the majority of the stock. Funny, but believe me, coders, people who can do those things are in very high demand. And then the rest, you just have to negotiate and have a consensus. So when people start leaving the room, everybody knows that you are still friends, but do this pretty much on day one. There are clients who come to me, let's say within 6-7 months of building the company. It's all they call stealth mode, but they formed a company. They filed the documents with the Delaware Secretary of the State, and they had discussions about how to allocate equity, but none of those things got materialized or memorialized in any documentation. As you can imagine, startup can be dead or in a different place within a month or two. Sometimes it's days that the founders have different ideas, things change. And if you don't have those issues addressed on day one, believe me, after 3 months you will not go home with an agreement that everybody expected. Things change. Someone who was happy with 25% now says, I need 40 because now I understand what you guys are contributing, and it's not what was expected. You were supposed to bring 800,000 or 900,000 to the company. You roughly brought 25 from your mom. What is this, right? You were supposed to be a great regulatory guy. You don't even know who to call now. We have problems. So many of those things change, and if they are not addressed at the beginning, you will have issues. And some of those startups fall down and people go separate ways. It happens too. Now, considerations for the founders shares. My advice to everyone, and this is all in connection with you being prepared on day one for the funding, because we are building foundations. If you don't have the foundation, then you will not build the penthouse. Or you can get to the penthouse, but then the structure will fail. I advise clients to find the $200, $150 and pay for the shares they get in cash. Whether they get 1.5 million or 2 million, doesn't really matter. You can come up with 200 bucks and you buy your 20, 40% stake in the company. I try to shift from putting the IP in front of everybody and say this is my payment for the shares, because there might be issues later with that IP that we discussed before, that someone will question this and say, you know what, there's a problem now. We don't want that. You can contribute in kind IP later without any additional shares, therefore, and that will be great. Now, item number 3, investors will not talk to you if at the term sheet stage you say, my shares are unrestricted and they will remain unrestricted. You simply ask them to leave. How do you deal with this issue? First, you know that they have to be restricted. So you restrict them on day one when people are buying the stock. So you don't have an issue. You don't waste your resources and pay the lawyers representing investors to tell you how to fix things and check whether you did it. You try to eliminate costs at every single point in your journey as a startup founder, because every single time you will be reminded by somebody what to do and how to do it, regardless of who these lawyers work for, you will be paying for them. That's the rule. You will pay for the investors' counsel, and the more cleanup you have, the more expensive they will be. So stock vesting. I'm sure everybody knows in this room the magic rule that's still in Silicon Valley, which is 4-year vesting, 1-year cliff, which means if someone gets stock today and leaves the company and is terminated 9 months from today, that person very likely will see 0 stock. Why? Because the company will likely buy that stock back at cost, because it needs to have that stock for another person who will replace this person who was supposed to be a big boss. It happens and will continue to happen, and people who claim that this is just a great team that will work forever are wrong. So just keep this in mind. There are situations where people say, you know what's done? We left big companies, we had enough money, we didn't really have to form this company, but we've worked for the last 9 months, the 3 of us, and now we've come to you, we want to have a company. And we've heard that there is some vesting going on. Tell us what we can do. We don't really want to start on day one. And in this case, if we have this story and we can easily track this down, look at the resume and say, okay, 9 months ago, this person left Cisco, did this in the garage on free time. Whether there is a company or not doesn't really matter. I'm perfectly comfortable having this person have an agreement that will say that the vesting start at 9 months. So the way we did those kind of transactions, we put that number corresponding to 9 months of vesting into the unvested shares, meaning nobody can touch them no matter what. And then the vesting of an additional piece happens 3 months later. So that's pretty much what we can do for those kind of startups. Just continue quarterly vesting, or in some other cases, to make things easier, we say, you know what? What's remaining of the first 25% of what you purchased will be vested on the 12-month anniversary. So you look like a normal startup now. You have the 4-year vesting, but we gave you the 9 months kind of upfront, and only 3 months of vesting will vest on the first anniversary. So you have the 25% vested on year 1, and then nicely continue on a monthly vesting for the next 36 months. In each of those instances, 1/48 of the stock will vest. Duration, some companies will probably ask you, if you are not the founder, you are not driving the show. Some companies in the Valley even try to impose a 5-year vesting. It's very rare, especially in situations where you can simply say, as employee number, I don't know, 35, you say, you know what, I have 3 other offers, I can just go and I prefer 4-year vesting. Or even you can be very strong and say, I want 3-year vesting because everybody wants me. And if they want you, they will probably give you that vesting. And the investors will not really question this too much because they want quality people. You know that in Silicon Valley, people are the most important assets. Without people, there wouldn't be anything here. Now, how is stock vesting imposed on the founders? In most cases, if you had that experience, you probably saw something called restricted stock purchase agreement, and that agreement will say how the vesting happens, whether it's 1-year cliff, monthly thereafter, sometimes 1-year cliff, quarterly thereafter. There are different configurations depending on the company's philosophy. Now, what happens when the company is bought on year 2? You still have 2 years of vesting in front of you, and one of the questions you will have, hey, CEO, what happens to my unvested stock? The CEO will say, hey, go and read your contract and you will know everything you need to know. But what are the options? And I'm pretty certain you've heard about terms such as 1-year cliff. Did I say this right? Now it's single trigger, double trigger. So if the company gets bought during year 2, and if you have single trigger acceleration, that means that immediately prior to that change of control M&A transaction, all unvested shares that you have will vest. So they are all yours. Investors do not prefer that approach, and startups that insist, because at the end of the day, lawyers can advise and the clients will make the final decision, and we can simply say, let's do it, but I'm sending you an email to tell you that when the financing happens, we will have to fix this. And some will say, we are willing to take that risk and it's fine. So we go with with the single trigger, and then double trigger simply provides that if there is a change of control, we start counting the 12-month period thereafter. So if you are terminated within that period of time, then your stock would accelerate and vest. Now, most transactions at the M&A stage will be either stock purchase deal or mergers where the parent company of the buyer will establish a subsidiary. The shares of your company will be nicely merging with the sub. You get the funds and nothing really happens. The vesting issue is addressed that way. But there are situations where you will have vesting in different configurations after the company is sold. And I had few transactions of that nature in the last few months. I also have some from about 2 and 3 years ago, and now I can see what's happening with the founders of those startups who got acquired and had, for example, 2-year agreements, and There were interesting mechanisms built into the M&A documentation and the employment documentation with the buyer. And some stories are very positive and some stories are not that positive. And those founders are, I think, revisiting their options at this time based on some, I would say, inadequate steps they made when they were rushing things, I would say. So not all M&As are equal. Just keep that in mind for the future. Now, I mentioned that I will tell you something about stock options. In my book, every startup should have a stock option plan pretty much on day one. Allocate 10-15% to your equity incentive plan immediately, and that's something that you can use simply as equivalent of cash for the people who you'll need. And you can say, hey, dear so-and-so, I cannot pay you, but you are in Arizona, you are in Utah, you can code. You will code this specific portion for me, and I will give you the right to buy 150,000 shares. At the initial stage, those shares are worthless, right? But believe me, sometimes 2 years, 3 years later, those shares are worth $1 million or 2 or 3, depending on what happens with the company. So I want you to look at this and just take a look at the initial allocation of the option pool. So we have founders with 4 million allocated to them. Let's just say it's 2 founders, doesn't matter. And 20% of the common stock goes into an option pool. So we have 4 million on the outstanding share basis and 5 million on what we call fully diluted basis. When the investors come and start talking to you about pre-money valuation and what they want to buy, this fully diluted cap will be extremely important because you are using that, and in this 20% pool, we get for 8 million pre-money, which is the same as the one in the next example, the investor ends up with 27% of the company's stock, right? Nothing really should bother you about this example. But take a look about a few inches below, and we only put 500,000 into the pool. The investor gets the same percentage, but the founders keep a little bit more. Why is this important? If you can get an investor agree to this second example, the next time the pool will be increased or the next investor will come, everybody who is in this company will be diluted. In the first example, who got mostly diluted? The founders, right? The investor just comes in after the fact. So depending on the investor, I tell my clients, hey, if we have an investor who will allow you to have the plan that you have already and then increase it after the investment, there are a few comments that could be made about that investor, depending where you are really sitting, right? So most will tell you the following: I want you to increase your plan pre-funding such that post-investment it will constitute 10% on a fully diluted cap. So that simply means I don't care how many shares you have, how many you will have, so long as when we look at the post-closing cap, we have our percentages, the pool is 10, and we don't care about what you had in between. But again, this depends on the investor, and believe me, you will meet different investors, very, very sophisticated and less sophisticated. And when you meet, especially at the early stage, when people are talking about smaller investments, the less sophisticated ones, this is where it's your time to play the game and simply, I'm not saying outsmart your partner in venture, but make smart decisions for your company. at the same time for yourself. One of the most important questions that follows this discussion, because now we are getting to the point where we are slowly talking about raising funds, is how much to raise. And the response is very simple. Depending where you are, you will base that response on the stage of your company. If you are still working on the prototype, of course you are not going to ask anybody for $5 million and nice Series A, right? But if you get to a prototype stage, someone gives you a few hundred more, you finally have a product that starts working, you can start talking to people about $1 million or more. I have clients who have a nice prototype and raised $2.5 million of seed money by issuing Series seed stock. So again, depends what it is. And for most audiences, such as yours, pretty much the story at this level is about the early seed and things I would call up to $3 million. That's pretty much where the discussion should end. They are things that 10 years ago, when I started in Silicon Valley in 2007, after a few years in San Francisco, pretty much nice Series A financings that I was closing at that time were 3, 4, 5 million was a pretty decent Series A. Today, I tend to start kind of Series A discussion, 5 and up. Those smaller things are Series seed investments. And the documentation is pretty much kind of an abbreviated version of the Series A, just it's called Series seed preferred stock. Now, next thing, depending on where you are with your company and the fundraising process, you have to ask yourself what types of securities I have available to me for issuance to certain investors. Again, this will again depend on who the investors are, how much you are raising, and then the responses are very simple. If you are raising 300,000, the only choices really you have are convertible debt and safes. And many of you have at least heard about safes. These are things that are, let's say, more recent than things of the past. These are called simple agreements for future equity. I call them kind of a waiting room document. Simply, you invest, you get a piece of paper 5 pages long that says the amount you invested will convert into preferred equity when the company raises preferred round. And it's up to you to choose from 4 different types of safes that are available online as documents you can get. I will quickly tell you that the most commonly used forms are ones that have the discount and cap. The next one is the valuation cap as a standalone feature without the discount. The next one is the MFN, which is most favored nations clause. That's a feature of one of the 4 types of the safe. Promissory notes you've probably heard about. This is a very old document, pretty much a debt instrument that allows the holder convert the invested amount and interest into preferred equity that's being raised by the company. And again, 10 years ago, very rarely we saw something as valuation caps. It was pretty much 20, 25, 30% discount from the price paid by the investors. A few years later, in sophisticated debt transactions, you would not find an instrument that did not have the valuation cap built into the documents, because investors simply realized that investing 100 or 200,000 into a company, which was a very significant amount, didn't mean too much when the company was selling preferred equity at a valuation of 150 million out of the blue, when the expectations were that maybe the round would be at 15 or 17. So that's why this valuation helps. The Series seed preferred stock is not that different from the stock that follows. It just seed is replaced with A, and few additional changes you would be noticing in the documentation, but pretty much the documentation is 80% the same for the last 2 points on this slide. And again, it will depend on the amount you are raising. If you are raising 3 million, people will not talk to you about Series A. These things are gone. It will be Series seed investment. 10 million, it will be Series A. Someone puts, I had a transaction a few weeks ago where we were doing Series A as the first financing, and most of my other transactions would qualify that investment as Series B. So there are some outliers where very heavy amount of money is coming to town on day one, and this was less than 6 months from the formation. Incredible amount of funding, but some companies need it. This is one of the crucial slides for people who are thinking prospectively and want to start something that will have just a success story behind it when you get to the discussions with the investors at some point. So it's almost a point in time that you stand up, look back and say, am I proud of what's behind me? Am I proud of what I've built? Because now all of that will be subject to pretty severe scrutiny. And that means someone says, we like what you are doing. We saw the press releases. We like your team, and we would like invest maybe 2.5 out of the 4 million that we think you are raising. We will lead the round. You just find another 1.5. We give you 2.5. And you say, this is all great. And of course, they give you the term sheet. You agree on the Series seed investment. Nothing special there, 3 pages. And one of the points there will be that this investment, of course, is subject to a non-binding term sheet, subject to some exclusivity and payment maybe of some costs. But it's subject also to successful completion of legal, financial, and other diligence. And this is what some founders really read and they run and hide and don't laugh, because this happens. And this is the moment where they don't know what they have in the Dropbox account or some other repository. They simply have documentation, but they are scared to talk about it. And they are not eager to open the data room on day 3 when the investors say, okay, so the term sheet is signed. When can we get access to the data room? And then there's a long pause and, yeah, we are busy at the moment. We need a few days and we'll be ready. It's just Joe, who is in charge of it, is now unavailable, right? So, you know what that means? People need to do the cleanup. And sometimes they don't realize this because they don't attend things like this. And this is not just to say that people learn everything they need to learn in those presentations, but the majority of those basic things are known to every founder. So again, what we talked at the beginning, IP, this is item number 1. Every single piece of IP that was contributed or built by the founders will be scrutinized. In many cases, it's just agreements that simply say, yes, I am a founder and I'm assigning everything that relates to this technology before I came here, and also prospectively, easy thing. Capitalization issues. Another point where people just say, there's 3 of us, no big deal, everybody has documents, fine. It turns out that someone, and this is 8 months ago, meant to pay for the shares, but didn't. Certain events happen, the stock is no longer 100 of a cent, now it's, let's say, 5 cents, and we cannot find the payment document. Okay, there are things to fix it. Again, some people fix it easily, some people have problems fixing it. Again, depending on who the founders are, how open they are to creative solutions. But what follows immediately thereafter, if the stock is unrestricted, it will have to be restricted. If the stock was restricted, many people are surprised to hear about something called 83B. Many of you know what that is and what you need to do with it. It's a document that has to be filed with our government, with the IRS, within 30 days of the transfer of the shares. And usually the transfer happens when you pay for the stock. Many people don't file those papers because why would they file something? And if they don't have someone who does it for them, that's a problematic situation later, because in a year when they are going to vest certain shares, in that year they will have to look at the price they paid and the fair market value of those shares. If they filed the 83B election, they would not worry about those things. They would only worry at the time they sell the stock and think about capital gains tax, and that's it. So there are some mistakes that some people make, and they have negative tax consequences. Now, I think the king in my world until today, because nothing has changed really in the last 10 or 15 years that I've been practicing law, I think grants of stock options by the founders still surprise me how creative people can be. And there is pretty much nothing that can be done with just straight face when you see a board consent. Let's say you got as an advisor a new client that's been in business for 18 months and now says, you know what, we've been doing things ourselves. There's 7 of us, the 3 founders. We learned everything we needed to learn ourselves. We saved a lot of money. Okay, good. And now it's a box. Still boxes are carried. And we have a term sheet. Can you just make sure that everything is fine, so we then upload this into your repository, you open the data room and everything is fine. And this is not a long story, but a very recent one, probably replicated many, many times. People see board consents where you have one board consent, one date, several stock option grants, and 3 different strike prices in the same document. Depending on the face of a person, this one is 3 cents, this one is 6, this one is 5. Can common stock be priced differently on the same date? There is only one answer to that, right? So imagine what happened next. When they used this form from somewhere, they thought that they can do anything they want. It just says what's the exercise price or strike price. The board consent is only 2, 3, 4 pages long. Now, all those people who got stock option grants got documentation that follows. So it's a stock option agreement, option plan, exercise forms. All this set of packages went to different people. People signed them. They came back. They nicely put them into the file. And now you have term sheet, and the other side says, open the data room, we want to see this. You need to work a few days to fix all of those things. And this was pretty much a 2-minute call to a lawyer of some sort who knew what was going on and say, hey, we want to sign this. Is this fine? No, the price has to be the same and it has to be fair market value on the date of grant. Come on, that's it. And they would know what to do, right? They would just put 3 or 4 or 5 cents, whatever the fair market value was, if they knew what it was. They apparently didn't when they were jumping from one place to another one. So that's one of the things that is very costly to fix, and it's very detrimental to your staff members now to tell them that, hey, Johnny, you got those options a year ago. We need to cancel them and you will get new ones, but the fair market value is X number of times higher. Is that fine with you? You have an unhappy camper because that camper believed that you knew what you were doing, right? So those things are not to be taken lightly. Now, securities law compliance, believe me, startups that do things on their own for the first few months, they are always surprised that there are some filings to be made with different agencies because they sold shares to few founders. Again, this is not surprising to me because there are so many things probably in the fintech or shared economy startup world that people would come to me and say, hey, Stan, you don't know that? It's so obvious to us, right? Again, what's obvious to me may not be obvious to you, and vice versa, right? So that's why we kind of collaborate and help one another to do things best based on somebody's skills and knowledge. And now common sense. How to close your deal on time. Again, if you are doing things properly from day one, meaning tomorrow you will form your startup, I can guarantee you that with good help, if you say today is the 1st, that we are closing Series seed of $2 million and you are, let's say, formed on January 5th of this year, we will nicely close this round by November 10th and nothing will stop us. If you attended this presentation, listened, and you are, let's say, building this startup, you will start in January of 2018, and let's just push things forward 1 year, and you will be getting that term sheet on November 1st, 2018, with the closing date of 11/10. I can guarantee you that you will close on that date. Again, why? Because you've been preparing from day one. There are now going to be any boxes carried to any offices with a question, how quickly can you clean this situation, or use some other word as you wish. If you have a team of 2-3 people, now you have to tell, as the CEO, listen, my financial guy, things that are related to finance, capitalization, it's on you. All those things will be coming from the other side. There will be questions, not too many, because we are still young. We don't have the annual financials done. So we are just at the early stage. You are taking care of those issues. You are the guy who coded this. You know where the code came. You know which licenses you use. There will be many questions about open source software, where this stuff came from. You know this. If you don't, start gathering this information, because in 5 days' time, there will be a call going through all of that with the other side. I want you to be prepared for that call now. So organize as the CEO, divide the tasks, so everybody, when they go home after the term sheet is signed, they know where they will be for the next 7, 8, 10 days, what they are responsible for. The CEO will take most of those calls, questions, and deal with those issues, but the others who are in charge of specific things need to be on alert. They are not going to Tahoe that week. And it's dedication and team effort. Now everybody knows that this is for the common good. This financing will raise the valuation of this company, will raise the value of each founder. And if the company continues doing that for the next year, 2 or 3, depending how much time is needed, depending on the industry the startup is in, there might be shorter or longer trip to the acquisition, but this is something that has to be done at this stage with a dedicated team, and I emphasize team, because many startups, if you look around and there's 7 of you and you cannot say that we are indivisible team, you already have problems. What will happen later when you have 15, 20 people? It's the time where you can really say, this team is one for all and all for one. So thank you so much. Please, we'll move the mic in front, and anybody who has questions related to what we talked about today, please ask questions. So I don't really want anyone going home tonight with some thoughts that you still don't have your issues addressed.
First, let's give that first stand. So if you have a question, come on up. We want to take as many questions as possible. Stan's not billing. So who's got a question? Come on up. Line up right here and we'll knock them off as quickly as possible. Go for it.
Hi, Stan. What's your view regarding milestone vesting, between milestone vesting and time-based vesting?
Some companies use milestones,
Yeah.
and it's mostly for what we use them, at least my clients, mostly for outsiders who are, in many cases, delivering things, saying, I will develop certain portion of your IP. And then we say, yes, fine. When you do this, you will vest in 25%. Then milestone 2, you are getting me the next 25% of the overall product you promised, you get another 25. So sometimes you change things because you are not going to have someone for 4 years if this is a consultant working on a project that will take 4 months, right? So you may say, you get the 100,000 shares and I will give you 25, milestone 1 achieved. My IT guy will say, yes, this is good, we accept, you vested, and we continue that way. Versus time where you have employees who work for the company and simply do their things, and they just have to be there and do those things for a longer period of time. Then we go with the 4-year vesting as I discussed.
Oh.
I have a prototype of a product that I built, and I want to show it to other people to recruit co-founders. What kind of agreements should I sign with them at this point so it doesn't turn into a Facebook movie?
So let me ask you before I answer this. Who are you from the legal point of view? Are you a company now or are you still an individual?
Still an individual.
Okay, then I would say if you have really desire to have a company and have team, have funding in place, I would encourage you, maybe not today, tomorrow, because it's already November, but come January 2nd, form a company, have set of agreements such as NDAs to start with after you issue stock to yourself. By you, I mean your company, but you will be the CEO and the main person. Have the stock issued and do not talk, especially with anyone, if that technology you've developed can be patented. If that's obvious to everybody, there is nothing novel. Yes, you can talk freely, but my advice, and this is what I didn't talk about the IP because we would talk for 3 hours, if you have technology that can be patented and you start disclosing this to others, this is no longer 2011 in the US. You have to think about patenting this so your rights would be preserved versus you go and talk to 2, 3, 4, 5 people. God forbid you go to some demo day or some pitch night and start really telling people what you have, because at that point you will no longer have a chance to patent that. So again, let's assume this is not something you will patent.
This is not a patentability issue. It's relating to first to file or whatever. It's what the product does, which is the issue.
That's fine. So if this is not subject to a patent, have an NDA with that person before you know who you are talking to. Explain what you really want from that person, and then have a smart NDA, because you can find online one-pagers that really will not protect you. So all those things that you will be disclosing, you want them to stay with that person for a year, 2 or 3, and trade secrets, if there are any in that technology, shall never expire. So pretty much there will be an obligation, indefinite obligation for that person to be quiet because of trade secret nature of those disclosures.
So, okay, so this might be an issue where it's the specific market. So say I disclose to somebody this product does X, Y, Z, and that person says, wow, that's amazing. I can't believe there isn't a product that does X, Y, Z. I want to protect the company from that person saying, well, I don't want to get involved with you, and then a year or 2 later saying, I had this discussion, it's my idea, he stole it from me, and very similar to other situations, right? But so it's not a patentability issue because there really isn't any, I mean, I wouldn't think.
So let me address this as your last question, then you will have more. I will address your questions afterwards because I want other people to have a chance to speak. So the best advice for you, in a hypothetical world, because I'm not giving any legal advice today, would be to have an NDA that has a non-circumvention component built into it, and then you will be fine. So again, that's the difference between, hey, let's find an NDA online, I found one, hey, can you sign it? Versus, hello, I need an NDA that protects me from A1Z, you get it, you are fine. And have that company form before you start really running to the market.
Hi, thanks for the valuable advice.
Pleasure.
I started a company in January 2016, incorporated. Like everything was done by the book except the voting rights and the vesting, because I started as a solo founder and I've been having a day job and then working on it in parallel. I made the jump 2 months ago and moved here to work full time on it. Now I'm looking for co-founders and building a team. So it didn't make sense to do any vesting back then because I was by myself. And the next step is to raise money. So first question, is it fixable? Should I fix it before even bringing people in and bringing investor? Both the vesting structure and the voting right part that you recommended.
If you believe that you have an outlier startup, which I believe you do, based on what you are doing,
Okay.
Everybody should really believe that they have an outlier startup, especially at this stage.
Yeah.
So if you want the voting rights, you can still do that.
Okay.
It's not a big deal. There are no other people. You are pretty much running your show
Exactly.
individually, so that's fine. The restrictions, you will have to have them, but it's a matter of you now having that fixed together with your voting, or you wait for the moment when the investors come and simply
Exactly.
say, hey, is
Yeah.
your stock restricted? No. Okay, we want you to restrict it, so just let's add a line to the term sheet, and it's simply done that way. So whether you fix this now or later doesn't really matter.
Okay.
The only thing, which is valuable, is that if you do it now, it's very likely that nobody will question your vesting schedule if you put back the start of the clock on the day when you purchase the stock or when you form the company.
Okay.
When you wait, it's possible, which happens from time to time, that the investors will say, and we want a 4-year vesting from the date you restrict the stock, which might be 5-6 months from today, right? So you are losing another year.
Yeah.
And then depending how strong you are, you will say, no, I will have 25% vested on day one. If they are the only one you have, they may insist on 4 years from that point and you will lose. So
there's interest into fixing it before.
I would fix that when you still have the leverage, because you are not answering to anyone.
Exactly.
Yeah.
All right. Thank you.
You're welcome.
Bye.
Hey, thanks for the chat tonight. So I guess one of the questions I have is I'm working with another co-founder, and we both just split the stocks 50-50 or whatever it is. But moving forward, like it's I don't really have the are you supposed to add like a value to it, like how many stocks you each have, or like how do those things work exactly? Like, because do you just make up an arbitrary number, like we'll have like 1,000 to begin with, and we'll just split it down the line, and then just kind of split down the line? How do
May I
things
ask you a question?
Yeah, absolutely.
What company do you have? Not the name, just is it a company called corporation or an LLC? Or
No, it's not incorporated. It's just like a personal kind of thing that I'm kind of working on, and we've built like a prototype and doing like research and stuff like that, and just yeah, nothing's really like official really.
So what you have is what we call a partnership, civil partnership. Pretty much there is no shares and there is not going to be any shares. So if you are serious about what you guys are doing and you believe that there is some value in the technology you are building, I would form a company, divide the equity, pay for the equity, and start doing things that you can say, I've been prepared from day one, rather than wait for your co-founder and learn that the percentage you offered then doesn't work anymore, and you have a problem that your company has more issues to deal with than anticipated.
Okay.
So as of today, you have pretty much no company. It's just partnership.
Yeah. So then I guess build off that is we just kind of like found these things online. It's just like a partnership agreements and stuff. That won't hold value to anything, right? It's just kind of like more of, in honor of this agreement kind of thing.
If you don't have anything and you want to have a company at some point in the future, the two of you could sign something that we call memorandum of understanding, letter of intent, whatever terms of agreement or letter agreement. And if you say, hey, dear co-founder, prospective co-founder, we'll form a company in January, just to wait to the new year. But let's write few things and sign this agreement, a binding agreement, that this is how we will organize the company. This is how many shares you will get. and who will be who, what the board will be, who will be on the board, who will be the president, who will be the CFO, secretary, those kind of things, then you can easily sleep and
Okay.
wait till January and you are fine.
Okay.
Nobody will question this. But if you have some oral arrangements such as, oh, I have 75% and the other says, okay, I'm fine with 25, that 25 may no longer be appealing to this colleague of yours 2 months from now.
Right.
So get that wrapped up and then you have a point of reference. Otherwise, I did not mean what I said.
Okay.
The 25 was about something else. The 25% was the vesting I was talking about,
Okay. Gotcha.
not
And
the shares.
And so, like, I guess final follow-up questions to that is, if so, something like that, do you need to kind of get like a lawyer for that, or you can just kind of figure out yourself, and that's like legally binding wise?
You can always do things yourself.
Okay.
Sometimes I think that I can fix my plumbing at home, and I think about this, and after an hour, I think that I need to call someone, and I usually call.
Okay. Cool. All right. Thank you so much.
You're welcome.
I have a question. What if you are and you have applied for the patent has been published a year later, but of course you have no guarantee that you will get the patent?
Your patent got published in a year?
Well, you apply for one and usually after a year it's being published.
And this is in which world?
In the world of medical devices.
When you do the expedited track.
Well, you apply for the patent, then after a year it gets published, right? And then
Yeah,
of course
when-
you have to
When you
put
do the
more
fast
money in
track.
there.
Yes, yes.
So at that time, an investor cannot be guaranteed that you will get the patent or not. So what
No.
did they usually do?
Let me just rephrase this a little bit, because you are saying about two different things. When a patent is filed, in most cases, people will go with the cheaper option, which is the provisional filing,
Yeah.
which doesn't do anything other than preserve the
Yeah,
priority date.
one
Now,
year usually.
Yes.
Mhm.
Then you file the non-provisional one.
Right.
And that's where the patent agent will open the prior file to see what claims you had,
Correct.
compare them with the new ones to see whether you can get the benefit of the prior date. If that happens, fine. But before the patent will be published, after the notice of allowance is issued, unless you do the fast track, that takes several years. We have sometimes patents that are allowed after a year or two in the normal scheme of things. But in most cases, it will take several years unless you do the fast track that we do for some clients. That's within 1 year, you basically file today, within 1 year you get the patent issued, or
Or
simply
you don't.
that issue will not be
Yeah.
patented because the examiner fought with you and simply said, no, this is not novel, this is too obvious, doesn't really pass the test. So if you have patent issued, then it will be published, of course. But if the patent is not fully prosecuted, it will not be known to the public for a long period of time, right? You have to finish the prosecution, and once the notice of allowance is issued, then you can say, dear investor, this is the patent application and the patent issued by the USPTO, then you're fine.
Okay. So investors would take that risk that at the end of the day, maybe in a year or 2 years, no patent will be issued.
What the investors do in most cases, let's say the trusted investors, you really want to be working with them and you know that they have excellent reputation, they will hire, they will get the documentation from you and they will have their own lawyers or patent agents who will examine your pending patent portfolio, see what the prior art was, and the lawyers will then write a paper to the investor saying, based on our research and analysis, we believe that there is 80, 90, 100% probability that this patent application will result in an issuance of a patent, and that's pretty much fine. But most situations will not have investors do that diligence if you have like one small patent and you just are at the prototype stage. It's more for more sophisticated technologies where there is a, let's say, larger patent portfolio and all of them are still pending. So it's more for those other things. In your case, the investor will simply say, we are glad that you filed a patent application, that you are protecting your interests, and we simply take the risk that,
Okay.
nothing may really happen.
Great. Thank you.
You're welcome.
Hi. So I just want to know what kind of an impact does the law firm have when you're approaching institutional investors? Let's say we incorporated and issued stock in 2 countries with a smaller law firm. And at some point we would like to go to an institutional investor. Do you think switching to a reputed law firm will have a positive impact or negative impact? Like, what's the impact?
You can have the best law firm on earth and that team and that product and nobody will talk to you, right? The law firm doesn't really mean too much at that stage. So you should have a law firm that's really suitable to what you are doing and the stage where you're at, right? So again, some individuals will have the best law firm under the sun, and that's completely fine because there is tons of lawyers anywhere. I would say you have to have excellent representation at a certain level and up. But the early stage where things are, let's say, easily accessible and more people understand how the system works, what you really have to have, how you have to have the basics done. And if you attend 10 of those presentations, you can be very, very knowledgeable about almost every single issue that you have to deal with during the first 5-6 months. Again, to tell you how valuable that is, I would need to know the name of the law firm, and just then if the reputation of that law firm for the things it does is excellent, then there is nothing wrong with it. If it's a lawyer that does immigration most of the time and claims that also that person is an expert in VC financing, that's questionable. So it again, just like we talk about some other pieces, it depends on the facts of each case, and then you will know whether you're in the right place. So we can continue this after the event. I can tell you what I think when I know more details, but there is nothing wrong with probably where you are now.
Thank you.
You're welcome.
Hi.
Hi.
Sorry for my English, first of all. Talking about money, we all know that it's very difficult when you start to develop a project to ask one amount. It's like ask someone how much you want to your baby or anything like this. So everyone have used to or underestimated the amount or under. And my question is, what do you think about the fact to say to one VC, okay, for the moment, I don't know how much I need, but we can fix it together?
Again, I didn't talk about this because that's not the subject. Today was how to prepare for financing, not how to do the financing, which would answer some of the questions you have in mind. But I will add to what I said today, that VCs are for you starting at a certain threshold. You are not going to go to a VC when you are raising $200,000. That's not the question for a VC. So I'm assuming, and by the way, your English was impeccable.
Thank you very much.
So if you are really eager to talk to an investor who you consider a venture capitalist, you better have an idea that you want 1.5 to 3 million bucks, right? If you say, I don't know how much you want to invest in my company, and that's something that you should know, but let's figure out this together. And finally he says, so just give me a ballpark. I'm thinking about 300,000. So why are we talking today, right? That would be the response. Again, there was one slide that I had about, let me just go to the slide. Take a look at this. If you are building a prototype, you might be fine with 100,000. You will go to some guys who you're associated with and say, hey, can each of you give me 20,000 and you will be partners in my venture? So that would be one thing. If you are past that stage, you have a nicely working prototype, you have 2-3 members of your team, you guys are building something, you are probably now looking for $1 million or more and going to slowly scale this business, right? So again, you will have to know where you are, how big your team is, and then what your projections are for the next 6, 12, 18 months, and then adjust the number accordingly, because you will be grilled about the use of funds. If you go somewhere and say, I don't know how much I really need, they will say, where are you now? There. How many people you have? X. Where's the product? Okay. How many people you have? Multiply by the salaries for the next year. At least you have that covered. More marketing and other things. And people will help you, but you have to really talk to the right person at the right time.
Yeah. Okay. Thank you very much.
You're welcome.
Hey, great presentation, by the way.
Thank you.
Two questions for you. Both are related to the connection with the employer that you're working with at this time and, you know, what you're doing. So question number one is, how far do we go investigating on, you know, the thing that you're working on overlaps with something that you work, maybe, for example, let's say in the last 10 years, I've worked with like 4 employers, right? Maybe some portion of what I'm trying to do overlaps with someone I worked with 5 years back in Dubai, let's say. So that's question number one, like how far we go investigating, how far we go back investigating. Question number two is, there are portions of the business which are kind of not novel to one company, but then they do overlap. For example, Facebook advertising is their thing, right? But Facebook is not the only platform that does advertising, right? And the standards that they use are being used by other social networks as well, right? So if, for example, in my idea, I'm also trying to monetize kind of similar fashion in which someone else is also doing, does that also goes into the same thing as we talked about? Like,
so let me address one at a time.
Mm-hmm.
How far do we go?
Yeah.
It really will depend on the type of IP. If we are talking about trade secrets, believe me, that will be a very long period of time. And nobody will really give you the carte blanche saying, yeah, you can do whatever you want. You will keep those secrets until you say the final yay or nay.
Mm-hmm.
That's one thing. Again, based on what you said, this is again one of those situations where I always say we'll have to have a longer discussion and analyze the facts and agreements that you sign, because sometimes there will be agreements that allow you to do almost anything you want under certain conditions after a certain period of time.
Mm-hmm.
So again, this is factual. And no one will ever give you a clear response based on the discussion we are having saying, yes, this is fine, you can do it, or you cannot do it, because it will be just a very bad response that you will hear. So this is factual. And how long depends on the type of IP.
Mm-hmm.
So that's issue number one. Item two, you will really have to see where you are, where you've been, where you are today, where you've been, and what you've been doing at each of those prior employers. Mm-hmm. So if 2 years ago you were at company X and now you're at company Y, which does completely different things, and your startup will be doing what the immediately prior company did, there will be a problem, right? If this relates to the company's business, your argument that I did this during my vacation in Hawaii will not really help you, right?
Mm-hmm.
So facts and facts and facts again. And once you have this analysis done by someone who really understands this topic, then you will be able to say, yes, I can do what I want to do. I can raise money. And the first point where you will be asked to explain the situation, you will put the letter or memo from your own lawyers to the investors saying, this firm analyzed the situation, and I was advised that under these facts, there is no taint. I can simply claim ownership of the IP I'm working on now. That's the first step, which is something that you should really have. So the discussion with someone who can look at the facts, not just in general terms, hypotheticals, but specifically what you have, and then you will get a very good advice.
All right. Thank you.
You're welcome.
Hi there. I have a question, two questions. The first is about a patent, similar to the previous question that dealt with the patent disclosure from the perspective of an investor. Let's say that I actually submit the filing for the patent tomorrow, and I know that it might be about 3 years until it's granted. And I also know that when I begin working with my key customers, that the pilot project will take 2 to 3 years. Is there a way that I can work with the customer, do a pilot project, have some kind of an expectation that's fair on both sides, and have the pilot project complete the same time the patent issues.
If you file the application, even the provisional yesterday, and you will be working with your customer tomorrow, you are fine. What you should be avoiding at all costs is talking to customers, any other partners, and then filing your patent application. If you've already filed, you will be fine because the patent is already on file. Whether you get it in 3 years' time, after of course you file the non-provisional one within 12 months, or maybe you file in 9 months and it gets issued 11 months later. There are situations where even without the fast track, if the technology you are creating is just so novel, you might be lucky, and we have some cases where we have fast track clients who get patents within a year, and we have the normal ones that just go the old way and also get all at once is the same time.
So your answer addresses the protection for me. What I was told from someone who works in the industry was that the customer would not agree to talk with me until the patent has actually been granted.
Then you will have few years of silence.
Okay, so that means that the sum of the time, you know, the 3 years till the patent grants plus the 3 years for the pilot project, that makes a 6-year runway, and that's pretty unattractive.
You need to talk to this person again, maybe under different circumstances, and ask them to call me maybe, and we'll have a chat, and then they will call you, and you will probably get an upgraded response.
Okay. And my second question, the allocation of equity, you threw out one number. You said the attorney might get 5% or something like that. But if you have a CEO that comes in, is there a typical range of equity that would be expected, and is that range, that percentage different if the CEO contributes early in the life of the company as a founder also?
Two different stories, because in most cases you hear that Mr. X is the main guy behind the company and this person is the CEO because of that. And then depending again on the allocations, this person might be holding 75% of the company and the rest will belong to 3 people and they will only have the remainder, right? So it's different. Now, in a situation where you have a CEO that comes later, because after 2 years and Series B investment, the company got 20 million from the Series B people, and they look at the team and say, the product is great. The team is almost optimal, but this person no longer qualifies to be the leader. We need to bring somebody else. And that somebody else will say, I like what I see, well-funded company, great future, probably in 2 years we'll have an exit. Okay, most of them will say, okay, I need 15 to 20% as a starting point, and I'm on board. You will not get a good CEO for 5%, because that's not going to happen. This is now the driver for your business. But it's not going to be 50 or 60, because that belongs to the people who started the deal when there was nothing. Now this someone is coming in using the experience from, let's say, a higher level of the company that this person was with most recently, and will take this company from where it is to that place where this CEO is coming from. So you are buying this block of experience, and the price is still 15% at that stage is a lot of equity, because you may get a Series B for 25 or 20, getting also 15%, right?
So at the early stage, the CEO might get 20% for CEO-ness and another 10% for founder-ness.
At the
beginning, yeah.
I have companies with 3 founders, and for example, CEO takes 80.
Okay. All right. So it can be much higher then.
Yes.
Yeah.
Not
okay.
that we'll name this person to be the CEO, but this is the person who came up with the idea. Just like the 3 of you may say, I'm the guy who has this great product in place. I've already started developing the technology. You guys are needed. Would you find this appealing to join me, and each of you gets 10%? I take 80, and they may say, you know what, I'm just out of college. I don't need too much to survive. I like this experience, and I might be somebody in 3 years' time because I can be 25 and I have a nice exit on my resume, right? So I'm a successful entrepreneur. It works. It really depends, again, the circumstances. I call it totality of circumstances will really give you the whole answer.
Okay, thank you.
You're welcome.
Thanks for the talk. In regards to the votes per share, what is the maximum that you can allocate per share, and what's the max you can allocate in general? And then coming from someone who's a single owner LLC, how can I best leverage that for my benefit when bringing people on?
Let me start with the second one first. This LLC that you have, is this for a product or more services?
Service.
Okay, okay. So the people who would come, would they be providing services to others just as consultants?
It would be more or less the sales team and developers developing out the service.
Okay. So what's the service that the LLC is selling?
For the business, that'd be something that needs to be patented before I go and talk about it.
Okay, okay. Now then, at some point, if you will be with that kind of technology, if you need to patent that, you will have to very likely convert this LLC into a corporation, because you will not really get in this region financing into an LLC with kind of the brief story that you shared with us. And once you have that, then you will have shares rather than membership interest, and you will start allocating equity to people as you wish, right? To the extent they agree to your wish, of course. Now, the question about how many shares can I have? As many zeros as you can think about. Is this good? Probably you are creating some outlier in a negative sense, because you are supposed to be looking on paper like any other Silicon Valley company, right? So rather than having 10 billion shares, try to have 10 million and then issue 5 of them to the entire team, and you will be fine. You will be like pretty much everybody else. Now, how many votes per share? As many as you want, but be reasonable, right? So if someone says, why did you give yourself 1 billion votes per share? You have to have a story behind it, right? Whether you are like a Guinness record holder or somebody. If you say, no, I didn't know, that's fine. If you do know, then you put 2, 20, 100. Nobody will blame you for that. It's still reasonable, and others do it. Right? There are some companies that have 170 votes per share, and that's fine. I had a client who had 100,000 votes. That's fine, but I did not have a client who had 1 billion votes per share.
Okay, perfect.
You're
Thank
welcome.
you.
Hey, thanks again for the talk. Earlier you had mentioned that some of the few steps in starting a company: incorporate, when you have a co-founder, set up your stock, and the third step you mentioned, buy your stock. You even mentioned that $200, $150. I didn't understand that concept. Do you mind explaining that a little bit?
Yes, very good question. It's, again, you are asking the question today rather than doing the things and then saying, were you expecting me to pay for my stock?
Yeah.
Yes. So this is how it works. You form a company, Delaware, California, Wyoming, if you really want to do that. And the charter document will provide authorization for your company to issue up to certain number of shares. In most cases, let's say it's the early stage, 10 million shares. And it will be 10 million, par value 100 of a cent, that's it. Now, you have a company that is able to issue shares, and you have no shares. So, the person who forms the company will be incorporator, who will elect the first board. You can be the first board because you are just solo, so you are doing things on your own. Now, the board will turn around and say, I, as the board, the most important body now in this company, approves issuance of stock to myself. It's 4 million shares, 100 of a cent per share, which translates into how many dollars?
400. Yeah, that's a lot.
And now you will sign a stock purchase agreement in which the company and you will agree that for $400 you will be buying from the company 4 million shares, and once you pay with your cash the company, meaning you take the check that you wrote from your personal XY bank account into the company's account, you will say XYZ Inc. $400, sign and go to the bank, open the bank account for your company and deposit the check. You are now the owner of your shares. This is what it means that you paid for the shares. That's why later you will read stories about shares being fully paid and non-accessible, meaning they are yours. Nobody has to now discuss whether they are paid or unpaid. They are fully paid, they are yours. And this is where you become, for the first time ever, the owner of your company. Not when you form it. When you form it, it's just a shell that belongs to no one.
Oh, okay. Well, like, let's say if you were not to do that, what would be the problems to...
When you are not to do what?
To buy the shares, like you explained just
Then
now.
you have a company as a hobby on your shelf and you are not the owner.
Oh. Cool. Thanks.
You're welcome.
Hi, thank you for all the information. Very valuable. Thank you. My question is around equity split. So we are 4 of us or 5 of us, and I'm really confused how to split the equity. Now, you asked us to use the common sense. I'm really doubting my common sense now. So, so how is there like a framework that we that generally everyone uses? That is first question. Second question is around the framework. Like, let's say we've got to put in the initial first $40,000. Let's say something like that to build the product a little bit. Now I'm putting all $40,000 myself, being the person who started the idea or doing it. Now someone else comes in, says, okay, he's an advisor, and he's ready to put in $20,000. Now, how much equity am I supposed to give him for $20,000? I'm really confused about the equity split.
Good questions, and I will say very good questions. Now, many issues with those questions. The first thing is this. You have to look at where the company is on day one and where you guys are on day one. Is the company there and all 5 of you are also there? Are you or not?
Pretty much.
Okay.
Yeah.
Then you really have to sit down and say who is contributing what and put the money aside. Put the value of your talent and skills and knowledge. Put the money completely aside. You should be walking from the table and each of you should pay only less than $500 per your shares, all of them, per person. The rest of the money should be another discussion. It's either a loan or capital contribution, but it should not affect the discussion about how much do I get because I'm bringing $40,000 to the mix, right? Because the others can say, you know what, we don't want that money. We will go to Joe and get the 40,000 from an outsider who will get that, and for a year he's quiet. He gets 0 equity today, right? So your goal will be to talk to your 4 other colleagues with a plan that you have if you are the mastermind behind all of it, and simply say, hey guys, the way I see this is I was the main guy, the mastermind, and I see this as follows. I see 45% for myself, I see 15% for Josh Mo, and I see the rest in accordance with the following schedule, and this is why. And I encourage you to comment on this so we all agree and have the discussion. So when you leave that room, there is an agreement that you have perfect allocation that everybody is happy with, everybody understands why, and then you will be happy. We'll have a good team because everybody was participating in this. Sometimes I invite, if I have more than 2, I invite people to come to my office and say, okay guys, sit down. What are you contributing? What are you contributing? What are you contributing? And the moments I see, hey, this can be purchased for not too much, those people are going down very quickly from, like, I wanted 15%. Now, you know what? Honestly, you are no longer needed in this startup. So are you fine with 5% and your contribution or not? And these are good discussions because now everybody's participating. It's not that I'm talking to one person and then another one is just shocked that something happened. No, it's reasonable. And at this stage, you do not dump equity on people who could really be replaced with third-party providers who may just take small portion of equity or cash later, even on deferred basis. So that's this. And I encourage you to have this discussion about 20,000, 40,000 and how much to give people. Deferred in time, and you say, perfect slide for this. I don't know how it ended up over there. But you say the 20 or 40,000 that you want to contribute now as one of the co-founders, you can make a capital contribution for 0 additional shares. Your tax basis will go in the stock, so you will get the benefit when the company is sold. Or to be safer, because you don't know what will happen with the company, give us the money, we'll give you a convertible note, and that's fine. You will get equity later when the big investors come. If this is one of the early people who will say, I cannot wait that long, I want for my money 3% today, and you need my money, and you say, you know what, hey guys, the 4 of you, we need that 40,000. We will not go any further if we don't have it by tomorrow, and he says he is going to give us. You will make that decision that this person becomes an equity holder, and the way you do it, because you don't want to sell the stock that you sold a few minutes ago to yourself for 100 of a cent for 40,000, this person will take 99% of your company, right? So you say, okay, Joe, you get 3% as we discussed, for which you will pay, let's just assume $30, and the rest we are dumping into promissory note, and you will get more equity later. Issue closed. Many companies do it in the Valley that someone says, I'm investing 100K, but I need to have now equity, and this is the percentage I need to have. Then we basically split and issue them that percentage of common at the fair market value, which is extremely low, and the rest goes to debt. So basically they get kind of additional benefit on the back end because they get additional equity later. The best way for you would be just to say, I give you either a note or safe, and you get equity later. But this is where you have 3 other people knocking on the door saying, hey, don't take this money, take from us, and we are fine with safe. And this is kind of on you to work towards having other people waiting to give you those other instruments versus those who knock and say, I need equity today.
Okay. All right. Thank you.
Welcome.
Thank you very much.
All right, let's give it up for Stan. So if you would like the slides, email Stan directly, and you can email Stan with more questions. His email address is in the event description. The video will be on our YouTube channel within a few weeks. Go to youtube.com/idea-to-IPO. We ran a little bit over, but again, as a courtesy to our hosts, we'd like to leave the building at 9:05, so you can continue the conversation in the parking lot, Red Rock Cafe, the Rosewood. Today's Wednesday night, though. Yeah. Anyway, thanks for coming, and see you next time.